If you bought Nvidia 2 years ago, well, congratulations. You crushed it. But if you're thinking about buying it today, then you're a bit late to a trade that the entire world already knows about. I'm not saying Nvidia isn't still a great company, but in order to find the next big winner, you need to be looking for a hidden gem before the rest of the world catches on. So today I'm going to show you 4 AI stocks our system rates as strong buys, but with a fraction of the hype already priced into Nvidia, and therefore likely greater upside ahead. They don't build the AI everyone argues about on TV. They build the things AI can't run without. The data layers, the connectivity, the security, and the infrastructure. The idea here isn't to chase the companies spending the money on AI. It's to buy the companies getting paid to help build out AI. All 4 of these stocks are very attractive right now, but I did save the best one for last, so be sure to keep watching all the way till the end. By the way, I'm Steve Reitmeister, but all my friends call me Righty. I spent nearly 20 years as editor-in-chief of Zacks.com, and I'm a partner at WallStreetZen.com, where our quant team built a system that scores stocks across 115 separate factors every single day to help you find the stocks most likely to outperform. And real quick, do me a favor and hit that like button. It tells the algorithm to put this kind of stock research front and center in your YouTube feed, and it takes you only a second. Before we get into the stocks, the usual reminder: everything here is for education purposes, not personal financial advice. Investing carries risk, and you're responsible for your own decisions, so always do your own due diligence. Let's get right into it with our first stock, OpenText, with a symbol OTEX. This is one nobody's talking about, and that's part of why it's so interesting right now. Here's the setup. Every company on earth wants to put AI to work on its own private data. The problem is that data is a mess. It's scattered across decades of documents, contracts, and systems that don't always talk to each other very well. Before any AI agent can do anything useful with that information, somebody has to organize all of it. That somebody is often OpenText. OpenText is one of the largest information management companies in the world. They just launched their AI data platform, built specifically to let AI agents tap into that messy enterprise data and actually make sense of all of it. They also expanded a partnership with Google Cloud to deliver it to even more customers, tapping into Google AI's models to do it more effectively. While everyone fixates on who builds the smartest AI model, OpenText quietly owns the plumbing those models need to reach a company's data in the first place. That's a great catalyst for growth thanks to AI, and it's happening right now. But here's what's strange. Neither the market nor Wall Street analysts has reacted to the good news. The analysts covering OpenText mostly have it as a hold rating, and the stock price has been kind of a slow mover. The oddity is those same analysts actually hold fair value price targets that are well above the current level. The most bullish analyst on the stock is actually expecting 70% upside on the stock for the coming year. The much higher expected value of the shares from Wall Street seems like a great contradiction versus many of the hold ratings, meaning they might be upgraded to buys in the near future, each one acting as a catalyst to push the shares higher. There's one more benefit I haven't mentioned. While you wait for the rest of the market to wise up, you still get paid. That's because OpenText has a dividend yield of 4.8%, about 3 times higher than the average stock. Now we get to the most interesting part, that being the Zen Ratings analysis of the stock across 115 different factors that point to future outperformance. As of the week I'm recording, OpenText earns an overall Zen rating of A, which amounts to a strong buy recommendation. That's because it ranks in the top 5% of greater than 4,600 stocks we analyze every day. The Zen ratings is composed of 7 component grades that allow you to drill into a stock's specific strengths and weaknesses. Let's see what that means for OpenText. We have a top 13% rating for growth. It's in the top 10% of all stocks for safety, and top 4% for the artificial intelligence grade. Quick note on that one because it trips up a lot of people. The AI grade isn't a measure of how much AI the company sells. It comes from our usage of AI to flag stocks that have the marker of those most likely to be timely outperformers. Back to the component grades. The real standout here is value. OpenText earns an A here, ranking the top 1% of stocks tracked in this category. This is based on 21 different measures of value. The 2 measures that best tell that value story is the shockingly low forward PE of only 5, when the average stock trades for about 20. Second, you have a PEG ratio of only 0.5. Anything under 1 screams serious value. When deep value and growth line up with our AI signal, that's a combination worth a closer look. The main weakness here is that tame price action that shows up in the D score for momentum. But when you put it all together, OpenText is a compelling stock to consider now. They enjoy a real AI catalyst fostering more growth, a bargain stock price, and a fat dividend to pad those final returns. Moving on, the next pick takes us somewhere most investors never think of when it comes to AI. But first, if you like how I'm breaking down these stocks, then I invite you to join me every Monday night at 7 p.m. Eastern Time when I do a free live training session. That includes a market update, trading plan to outperform, and my top stocks now. Register now by going to the link you see on the screen. Again, it's free, and I look forward to seeing you on Monday. Now we move on to the second AI stock in Digi International with the symbol DGII. Everyone pictures AI living inside giant data centers, but the next wave is happening at the edge. What does that mean? Out in the real world, we have factory floors, delivery trucks, energy grids, and medical devices. All of it needs to collect data, process it locally, and connect back to the network. That is all happening at the edge. Digi builds exactly that. The rugged routers, the connectivity hardware, and the management software that links millions of devices in the field. And here's the shift that makes this really interesting right now. For decades, Digi sold you a box, you paid once, and then that was the end of the revenue stream. Now they're rebuilding the company around recurring revenue, the kind of subscription income that shows up year after year, whether they sell a new device or not. The centerpiece of that move came earlier this year when Digi acquired a company called Particle, an edge-to-cloud platform that pushes them right into the heart of the edge AI story. That one deal boosted the recurring revenue in Digi's core product segment by more than 60%. This is a hardware company quietly turning itself into a software-style business, and that transition usually comes with richer margins and a higher share price valuation. And the business underneath it is durable. Digi has delivered consistent earnings growth over the past 10 years. Plus, their gross margins are quite healthy, sitting above 63%. This isn't a speculative AI story. It's a real profitable company, and on top of that, it has a clean balance sheet. Its debt is ridiculously low, very modest debt-to-equity ratio of only 0.46. But that wasn't the best part. The best part is forward-looking. Digi is forecast to see robust earnings growth of 51% a year. That was raised after the Particle deal, pointing to being a strong catalyst for future company growth. The Zen Ratings model is picking up on this same excitement. Overall, we have another A-rated stock, this one in the top 3% of all stocks analyzed based upon its special fundamental profile. Drilling down to those component grades, it ranks in the top 15% of stocks for safety. Even better, top 12% for growth, and on top of that, 9% for a proprietary AI factor that I talked about earlier. Its strong suit right now is the top 3% showing for momentum. Gladly, our momentum score points to stocks likely to continue their ascent, so you could put it under the heading of buy high and sell higher. On top of all that good news about the stock is also in the A-rated communication equipment industry, so we are talking about buying one of the top stocks in a top-rated industry. What we have here is a real edge AI catalyst pushing up growth expectations, and that pushes up likely value of these shares in the weeks and months ahead. Now, the next stock is the smallest and most under-the-radar name on the list, and that only adds to its appeal, so let's take a look. Real quick, if you're getting value out of this, then take a second to subscribe and hit the notification bell. That's because I put out data-driven stock pick videos like this every week, and that is the best way to ensure that you don't miss the next one. Let's keep the party moving with stock number 3 in Riskified with a symbol of RSKD. This is the under-the-radar name I just previewed. Consider online payment fraud costs merchants around $48 billion a year worldwide, and that number is on track to pass $100 billion by the end of the decade. As shopping gets automated, this target will only get bigger and bigger over time. That's where Riskified comes in. The company runs an AI-powered fraud prevention platform for online merchants. When an order comes in, their system decides in a split second whether it's a real customer or a scam, and then Riskified guarantees that decision. If they approve an order and it turns out to be fraud, then Riskified eats that loss, not the merchant. That's a powerful promise to make, and it only works if AI is genuinely better than everyone else at spotting fraud. So the entire company is built on the quality of its models. And here's something cool to consider. Every transaction Riskified screens makes its AI a little smarter. A smarter model catches more fraud, which attracts more merchants, which means more transactions, which makes the model smarter still. That is an appealing virtuous cycle for their business. Here's the Wall Street picture, and it illustrates why this is a potential get-in-early pick. Coverage is nearly non-existent. That means as their growth story unfolds, they will no doubt get new buy recommendations. Each one will act as a fresh catalyst to push shares higher. This is a great benefit to early movers in these shares. The problem is how to feel confident about a stock with so little coverage. The solution is the Zen Ratings, where we can analyze a small stock by the same 115 fundamental factors we can apply to larger companies like Nvidia and Apple. Thus, good to know that Riskified scores an overall A rating as it ranks in the top 2% of all all stocks analyzed by our model. Here we have a wide range of standout component grades. Top 21% of all stocks for financial strength. Top 18% for sentiment, meaning the smart money is on board. Top 3% for AI signal, pointing to timely shares. And best of all is the top 2% showing for growth, which is focused on the consistency of growth, which foreshadows more earnings beats ahead. This makes more sense when you realize they're on a bit of a hot streak when it comes to earnings, especially over the last 4 earnings reports. And if you look at the earnings per share year-over-year change column, well, that's some serious earnings growth unfolding, and we're still in the early innings. So let's quickly recap. With Riskified, you have top-tier growth with a company using AI for a large use case in online e-commerce. Perhaps best of all is Wall Street is asleep at this moment, but that won't last for long because the Zen ratings shines a light on its exceptional fundamental profile that generally points to stocks ready to outperform. By the way, I want to remind you, if you like deep dives on top stocks, you can get even more when I go live this Monday at 7 p.m. Eastern Time. I always start with a timely market outlook. Then I dive into a strategy that should beat the market. Then I share my hand-picked trade of the week, blending the power of the Zen ratings model along with my greater than 40 years of investing experience. All this and more is part of our live training session this coming Monday at 7 p.m. Eastern. Totally free. Just sign up at WallStreetZen.com/live. You'll also find a link in the description or scan the QR code on your screen. Whatever it takes, I look forward to seeing you there on Monday. Let's close out this list with Hewlett Packard with a symbol of HPE. No doubt you think I've lost my mind, as most investors have written this stock off as some kind of tech dinosaur. Yet amazingly, the stock has a very recent catalyst that changes the story completely. There's a big debate in AI right now. Companies want the power of AI, but a lot of them can't just hand their data off to a public cloud. Picture a bank with its customers' financial records, or a hospital with private patient files, or a government agency with classified information. Regulation, security, national interest, all of it means the data has to stay in-house, under their own roof, on their own equipment, but they still want the full power of AI running on top of it. Hewlett Packard has become the go-to company for solving exactly that problem. They sell the servers, storage, and networking that companies use to build their own private AI infrastructure. On June 1st, the stock reported its fiscal second quarter earnings, which was a monster beat, pointing to 107% year-over-year growth. In fact, this was the 5th impressive beat in a row, and the AI numbers were staggering. AI infrastructure revenue jumps 52% from a year ago, and the company told investors it was the stronger AI server backlog it has ever seen. Management raised guidance for the year ahead. After that report, the stock jumped sharply, yet there is ample reason to believe in even more upside ahead. For example, Wall Street analysts remain very bullish on shares, with a lot of buy and strong buy recommendations on board. Even better, not a single sell rating on the street. The best news is the fair value price targets applied by these experts. As the week I'm recording, the average price target implies upside of almost 40% in the coming year, whereas the street high target calls for potentially 60% gains. A big reason for the upside is that management has implied that orders are stacking up faster than Hewlett Packard can fill them. The company has a record backlog. This generally implies strong pricing power that helps fuel more earnings growth and, yes, share price appreciation. Note that analysts expect HPE to grow earnings 50% in the year ahead. That pretty well debunks the out-of-date idea that this is a tech dinosaur. The Zen ratings corroborates those lofty expectations for Hewlett Packard with an overall Zen rating of A. In this case, we're talking about a stock in the top 1% of all stocks we track. Please note that the 115 factors of the Zen ratings are selected based upon how predictive they are about where stocks head in the future. So yes, our top-rated stocks generally outperform the market by a wide margin. Once again, the component grades tell an exciting story. Top 20% of all stocks for value, top 18% for AI timeliness grade, top 10% for momentum, top 4% for growth, and also top 4% for sentiment, which shows the smart money is already circling this stock. The drawback here is that shares have already enjoyed a strong run of late, and a pullback or a round of profit taking wouldn't really shock anybody. But here's the bottom line on Hewlett Packard. You've got a strong AI infrastructure catalyst pointing to serious growth, ample Wall Street support, and a top 1% showing for the Zen ratings. This all increases the odds for shares to top the market in the months and years ahead. So there's an early look at 4 AI strong buys that most investors are missing. Each is focused on a different piece of the AI story, from the data layer to the edge to security and finally infrastructure. And the Zen ratings is flagging each of them as exceptional investment opportunities at this time. Now I want to hear from you guys. Which of these 4 stocks caught your eye, or other AI-centric tickers you're bullish on that I didn't cover here? Share it all with the rest of our audience in the comments section below. And if you want to find even more exciting opportunities like these, then check out the video that's popping up on your screen right now. In that one, I break down 7 AI stocks that could create real generational wealth.